Denise, great to see you. Great to be here in Fidelity's awesome chart room, which we'll talk about in a minute. But let's start with the tech bubble, as people want to focus on. Tremendous performance for at least some of the leading FANG tech stocks and others. Lots of people very worried that it's another 1999. Are we in a tech bubble?
So I do historical probability analysis for Fidelity. We have great internal data sets with great resources. And I think history can really lend a lot to this discussion. And there has been a lot of discussion is this a tail event? Are we seeing something toppy in the market? And we can assess that in at least three ways, if not many more. The first is looking at cap-weighted versus equal-weighted. Cap-weighted has outperformed equal-weighted, suggesting that maybe a certain portion of stocks are really responsible for the bulk of the gains. But if you look at that 6-month change going back to 1980, we're barely off the historical average. And if you plot that on a histogram, we aren't anywhere near a tail event. And in fact, when cap-weighted outperforms equal-weighted, in the magnitude that we've seen, it actually has good odds for the market on a go-forward basis, not suggesting there's any kind of reduced probability of advancement in the S&P. Another way to look at it is people talking about just a handful of stocks, really representing 50% of the gains of the market. Again, sort of a commonality. Usually when the market goes up, people forget with our 8% historical averages. But when the market actually goes up, it goes up in excess of 20%. So what we've seen actually is some modest gains historically. And when you look at those modest gains, it's very typical for 50% of the market to actually on a median basis account for just a handful of stocks, about 13 stocks, which is about where we are now. And again, that has good go-forward odds. And the third way is really discussing technology specifically. Since I view the market through sectors, we can look at any leadership, specifically here technology, but going back in time, any leadership, the top sector versus the second best performing sector, the average, or the least performing sector. And we're, again, dead on historical averages. And what you see, which I think makes sense to people, is if you put like a business cycle indicator over that, like say leading economic index, you'll see that the market gets more narrow as the economy deteriorates. And you can see that we're dead on where we should be for this point in the cycle. So the way I look at it, I don't see any tail event based on history.
And yet, can stocks like Facebook, Google, Netflix, Microsoft, and others that have performed so well for so long, is it unlimited? Just continue forever? Or you're just saying, look, there's nothing that looks out of whack historically on valuation or other ways of looking at it?
So I think number one is, does anything look like a tail event? In the absence of a tail event being something extreme. So tech stocks outperforming so much that it reduces your odds and you only have 30% odds on a go-forward basis. But barring that any extreme measure, which we're not seeing, you have to go back to assess the critical drivers of each sector. And that's really key. And for technology, there's three: ROE, operating margins, and relative earnings growth. And actually what we've found over the last year is technology has struggled on an operating margin basis, return basis, and relative earnings growth has actually been negative. So excluding this last 6-month outperformance period, what you saw was very overlapping outperformance, if any, in technology. So it really held it back. So going forward, what you need to think about as an owner of the technology space is, what do I think about those critical variables? Now, I can tell you that when I look at them, when relative earnings have contracted, you do have good odds at that snapback. And we're seeing leading indicators, most specifically in terms of CapEx to sales, which technology companies have reduced across the board almost, and being a leading indicator to margin expansion. So I think that those are the key things that you need to watch going forward. And if we see maybe 1 to 2 years out margin deterioration, that's when you need to worry about your technology positions.
So your guidance to Fidelity portfolio managers and clients is, hang in there. Like, everyone is overweighted on tech, or at least has a lot of it. It's working very well, but no worries, hang in there.
Right, and specifically on a growth tilt, because what you're seeing for the first time really in a couple years is that growth is actually cheap relative to history in technology. Right now, over the last year, it's been dominated by cheap growth names in financials and industrials. Tech has just recently joined the party. And with valuation spreads at all-time tights, we look at a bunch of different valuation indicators, it suggests that growth will continue to outperform.